Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Chicago wheat, Chicago corn, and Kansas City wheat. Chicago wheat. The bright red highlighted neckline extension to the February to April reverse head and shoulders pattern, which is currently at 565, slowed and eventually halted the market's decline from the big move down from May. During July and August, it also halted a resurgence higher. Additionally, the congestion we saw previously from mid-February to late April impacted on the market's decline, and we formed a small bear channel from late June to the end of August. This bear channel was part of a V-top formation formed in May, in essence a V-top with an extension. The pressure in such a pattern tends to be for lower prices, but 7 weeks ago the market struck down to the important 38.2% absolute Fibonacci line at 521, which ignited the next phase, the very recent bullish incentive, enough to push up and out of the bear channel, as well as over all the moving averages, the December 2020 low at 566, the neckline extension itself, and up through the previously mentioned mid-February to late April congestion, as well as the newer July to August based congestion, which stretched up to the March 2021 low at 592. Then late 5 weeks ago, prices pushed up over this, as well as the July 2021 low at 609. However, for a while this move up was not sustained. As up there, we also had the combination of the flatlining gold long moving average, currently at 594, and a dipping medium moving average, currently 587. Now, these two, plus the surprising resistance of the July 2021 high at 609, which to be honest, I previously hadn't rated very highly, tried to cap the rise, making the market think twice about the rise over September. All this was interesting, as beyond these we had open air until the base of that old small descending triangle back in June in the 629 area, and also at the 50% Fibonacci line, the late May to late August move at 630. Now prices did move up, but they peaked 2 weeks ago within the body of that old small descending triangle. 6 weeks ago I said, and I quote, "We'd need to at least be seeing consecutive closes over the 50% Fibonacci line of the May to August move at 630 to consider such a situation as a longer term possibility, end of quote. However, we never saw that, with just a single close over the 630 level. In reality, what we have seen over September and the 1st of October has been the creation of a dark blue highlighted bull channel, currently 628 to 672. It's not a great looking example of a bull channel, but it did still exist. I said 2 weeks ago, and I quote, "The key to sustaining this bull channel will not just be staying above the lower bull channel line, but staying above the July 2021 low at 609. And trying up beyond the 50% Fibonacci line at 630 once again, and finally trying up towards the interesting 50% Fibonacci line of the March 24 to August 24 move at 658. All in all, a tall order with many things that could go not wrong, but awkward," end of quote. Well, since then it has certainly gone awkward. Awkward enough that not only are we below the key 609 level, but we are today with a possible daily key reversal down and bearish engulfing pattern combination, pushing below the gold long moving average, on the verge of testing that and pushing below that gold long moving average, and the nearby 2021 low at 592. Thus, we now also have some potential targets below for the break below the bull channel, of a primary target X down in the 564 zone and a secondary harder to reach target X1 down in the 561 zone. A possible tertiary potential, not marked as a target right now, is down in the 541 zone. Chicago corn. From the small double top pattern in May, prices headed lower below all the moving averages in mid-June and accelerating the fall once past the hurdle of the November 2020 high of 539. Prices finally halted in July between the November 2020 low at 403 and the October 2020 low at 387, creating a teeny triple bottom, and recovering 10 weeks ago up to the 50% absolute Fibonacci line at 425. Now remember that level, it will become important in the future. Anyway, in the process of pulling back up, the market made a small July-based ascending wedge pattern late 10 weeks ago, the same week as reaching that 50% absolute Fibonacci line. So prices penetrated the lower trend line and exited the pattern. The market easily reached the primary target, but it took until mid-August to drop down and reach the secondary harder to reach target. 9 weeks ago, I added a thought, and that was to look at the mid-June to late August action as also a possible descending triangle. There were arguments against this idea, but I did find it elegant at the time. 8 weeks ago, prices exited out of the upper trend line of the descending triangle idea, but instead of heading higher, they headed lower, down towards the flat lower trend line. This looked like a false break higher, but instead the market also created another pattern, a late July to late August shallower and smaller descending triangle. This triangle, like the former one, had false breaks lower, and it was finally 7 weeks ago that we saw its true direction, upwards. Prices punched through and for a while ran along the top of the late May to mid-September downtrend and its then accompanying partner, the short medium moving average, currently at 415. It's highlighted in green on my daily chart. This break higher reached the primary target for the descending triangle and 4 weeks ago gapped up over the secondary harder to reach target. We saw prices rise even higher, including changeover. The move up pushed through the February low at 409, the December 2020 low at 414, the significant, important and previously mentioned 50% absolute Fibonacci line at 425, remember that one, as well as the declining mauve medium moving average, currently at 420. 3 weeks ago, prices came up against the next series of overhead resistances, the November 2020 high at 439, which supported the market back in late March and April, as well as the declining long moving average, currently at 435. The market finished 3 weeks ago with a weekly key reversal up, and the following week punched up through these resistances into another congestion area between 440 to 450, dating from late March to late April, plus further congestion around 455 dating from June. And finally, on top of all that, the lower trend line extension of the July 23 to January 24 descending triangle, currently at 464. To cope with these, the prices started forming an ascending wedge pattern since mid-September, that's currently 462 to 476. I did not highlight this pattern, unlike others elsewhere, as it was, and I quote, still pretty nascent, steep and narrow, and I'm not sure of its sustainability. That's from 2 weeks ago. End of quote. Well, I was right not to do so, as prices last week dropped down and out of this pattern, achieving both the primary and secondary targets on the downside. We are now back down to the supports of the mauve medium moving average, the green short medium moving average, and the December 2020 low at 414. Plus, we have just about filled in the changeover gap left over from mid-September. It'll be interesting now to see how the market deals with the support and congestion below, generated between late July to mid-September. I'm not sure the overhang we have from mid-September to date would be enough, but we shall see. Kansas City wheat. During February through to April, we saw the development of a rectangle pattern based on the 551 to 590 area. Now, please remember this area as it become relevant to more recent action. Anyway, over the creation of the V-top in late May, prices rapidly descended down to the bright red extension to the lower trend line, currently at 578, on the late November 2023 to end of March 2024 descending triangle, along with the important July 2021 low at 578, and a little further down the March 21 low at 559, and back into that previously mentioned rectangle pattern area between 551 to 590. Prices subsequently moved sideways to a little lower, making a shallow bear channel. Altogether, this pattern construction is the familiar V-top with an extension, as we have seen in other grain markets. I cautioned on this at the time to watch for the bear channel to show immediate support and resistance levels, and it did so more or less until 6 weeks ago. I'd also caution that the pressure in any such pattern would be for lower prices, but the move lower 8 weeks ago was not sustained, and the market reverted back up, moving higher, bouncing up from the significant support of the important 38.2% absolute Fibonacci line at 533 into a flattened V bottom. The move up went through the March 2021 low at 559, short medium moving average currently at 584, and punched up and closed over the combination of the July 21 low at 578, the bright red extension to the lower trend line, and of course the upper bear channel line. 6 weeks ago I said, and I quote, "This move higher is having trouble in sustaining the move higher, running into the highs of early and mid-July and mid-August, as well as the top of that old rectangle congestion area between 551 to 590. Beyond these resistances we have fairly free area until the flatlining pair of the gold long moving average, currently at 604, and the mauve medium moving average, currently at 595, and the interesting 38.2% Fibonacci line of the big old 2011-2018 move at 618. Beyond that we have a small free area until the recent 50% Fibonacci line at 643, and the January 2015 high at 646. All this is leading me to think that the very recent move higher may not have the legs to get up through all these. To show you how I feel about it right now, this is despite the weekly key reversal up last week, so that's now 6 weeks ago. And even to target X at 627, this is the topside target I felt obliged in putting after the break up and out of the bear channel, even if I don't have much confidence in it being achieved soon." End of quote. Well, the action since then, and I quote from 5 weeks ago, specifically on the bright green short medium moving average, we may have gathered enough ammunition to tackle those overhead resistances, specifically the gold long moving average and the mauve medium moving average, and may just reach target X and even exceed it, because beyond target X there's only the January 2015 high at 646, which doesn't look that strong. End of quote. However, the effort in getting up through the significant 38.2% Fibonacci line eroded the bullish incentive enough that prices stalled last week, and this week have headed lower. Now, the market did manage enough energy to reach target X at 627 2 weeks ago, and in the process of doing so, created a dark blue late August to mid-October bull channel that is veering towards an ascending wedge pattern, currently 620 to 662. I said the following 2 weeks ago about this bull channel, and I quote, "For the moment, I will suggest following this bull channel to show the bullish angle of attack of this market, but please bear in mind that it is still a relatively early pattern. End of quote. Well, this week prices have broken down through the lower trend line, and we are on the verge of forming a daily key reversal down today through down through possibly the mauve medium moving average, is actually putting up a good fight at the moment as a support. Nevertheless, we now have targets below of a primary target X down in the 531 zone, with a secondary hard to reach target X1 down in the 527 zone, and a possible tertiary potential not marked as a target right now, but that's down in the 499 zone. However, please bear in mind that beyond the mauve medium moving average, you have the bright red trendline extension, the March 2021 low at 559, and the important 38.2% absolute Fibonacci line at 533. And I'm not sure the market has the strength from the late August to date overhang to make it that far just yet. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Toftwick and ADM Investor Service International Limited. And here comes the final important bit.